There's been a lot of financing going on in the senior housing industry. REITs have been dominating the news, but there's nothing like the old-fashioned balance sheet lending to get transactions done. And I'm sitting here with Doug Korey. He's the managing director of Contemporary Healthcare Capital, which has a variety of funds specializing in senior housing and care. And Doug, it's been a few years since we've sat down like this, and in those years it seems like your business has really expanded. Is your phone ringing off the hook these days?
Absolutely. I mean, particularly the last few years as certain finance companies and banks either started to restrict some lending to the sector or remove themselves from the sector, we've had a lot of opportunities present themselves.
And because you are using your own funds and not using other people's money, does that give you much more flexibility with your customers to get transactions done?
It's important today more than ever that the customer know that they can have a lender who can execute. And I think there's too many times where they've been down the road, particularly in the last few years or in any cycle that has a reimbursement cut or any of these issues that make people pause in their lending programs, to know that a team can execute, particularly when an acquisition needs to happen right away, or you need to get in the ground on a construction project. That's when you need somebody with a balance sheet who knows what they're doing.
And when you guys started your funds, you were initially primarily a mezzanine lender, filling that gap. Then you added the senior loan part of it. Then you added working capital lines of credit. You basically can provide the entire financing transaction for someone. And if you've got a good operator, a good customer, but they're just thinly capitalized, you're doing it all for them? Does that help you with that kind of a customer?
Absolutely. Again, we started out as our core is mezzanine financing, and I think that's been our differentiating factor to banks and other finance companies that are still doing what they do. But there are times when senior capital is either has retracted from the market, particularly in this phase, construction and turnaround financing, or perhaps banks are lowering LTVs and the like, and a borrower needs to get a deal done. If you're a good operator and you have a good background and you're doing the right things, then there should be somebody there that steps up with the majority of the capital. That's been our bread and butter. And it gives an alternative to refinancing. So you do have choices in the marketplace. We're not for everyone, but just like a REIT's not for everyone. But there are different choices that they can have.
Do you, and when you're doing a loan package, do you prefer to do the working capital line of credit, or do you not care if they take that part of it to a bank?
Well, it depends on whether or not we're doing the entire deal, in the sense of the senior and the mezz capital. If a bank is, and we still do a number of deals where the mezz is our only piece in the deal. A senior bank comes in and does that senior piece to it, and then we're more than happy for them to do the working capital financing. But if we're doing the senior capital and the mezz capital, it doesn't make a whole lot of sense to get into intercreditor issues and lien issues. It causes a greater expense to the transaction for the borrower, and it's just easier for us to do.
Right, and the loans and mezz investments, and loan or investment, however you want to call it, they come from different funds. Is it easier for you all to raise money for one kind of a fund, like a mezz fund, as opposed to a senior loan fund, or?
Used to be the case. I think more and more people see us as a blended finance company more than a fund group of funds or fund manager. So investors tend to see us as the hybrid, and if we're creating that hybrid return, I think our next fund, which we'll probably get going with next year, will be that hybrid product. So it's a more seamless transaction to our borrowers. We can do senior, we could do just mezz, or we could do that unitranche product, from one fund.
Mm-hmm. And it seems like at least in 2012. There was a fair amount of construction or acquisition with substantial rehab. Is that something you're targeting, or are people who want to build or rehab coming to you for your flexibility of products?
I think it's both. We certainly are targeting. We see that as a niche that's underserved. We see a very frothy part of the market for refinancing and cash flow lending. But for the industry, we have an older stock of certainly of nursing facilities, and even on the assisted living side and memory care side. I mean, we went through a huge round in the mid-90s and not much lately in the last 5 years or so. So there's a lot of opportunities for construction. There's a lot of opportunities in the skilled sector that we've been dealing with, where if we're going to create a new vision of what a skilled operator has to deal with, and whether it's an ACO model or it's some other function within that marketplace to take on a higher acuity resident, that facility needs to be upgraded. And that's where we think that from a vision perspective, we want to work hand in hand with the operator. And there's not capital, certainly not enough capital out there from lenders today to provide that.
And what kind of borrower are you looking for in terms of size of operator, location, history of operations, that kind of thing?
We've never been the 50 to 100 facility lender to that type of group. We've been certainly on the small to mid-size, but our range has certainly increased from somebody who has a single facility all the way to somebody who has 30 or 40 buildings. And we've been, certainly I think a lot of that has been generated from the capital markets, downturn. But I think that will continue even as banks come back, because people have learned that they need to have different sources and different types of capital. We see a lot of people who relied on certain equity partners that are no longer available. We fill that gap. We see people who don't want to take on partners anymore. They like the prepayability of a mezzanine tranche to the structure. So as people learn what different financing products are out there available to them, consistency of that, I think our range of operators has really grown.
How about, are you pretty much east of the Mississippi, or even further east than that?
We have had facilities in over 35 states.
Oh, so, really?
Yeah.
Wow.
And we're in certainly well over 20 states now.
Oh, okay, that's pretty. I kind of always thought of you more the eastern part. And then I know most of you, or all of your business, has been skilled nursing, assisted living. Any interest on the independent living side, or maybe CCRC, or is CCRC too big for your funds?
CCRC are too big for the funds, I think. Certainly on the independent side, we turned away from that as a standalone product several years ago. We'll certainly do it as part of a retirement campus, but we like acuity. We like the need for excuse me, somebody to have to to care for someone. And I think on the independent side, there's enough people on the lending side that can do that business. I think it's more closely assimilated to multifamily and senior, pure senior housing without service. And we like to position ourselves as more of a knowledge-based healthcare lender who assists the borrower not just in what we provide them in terms of capital, but we help with their exits. We introduce them to different folks on all different components of that, and I think that added value is more towards the knowledge base of skilled nursing, higher acuity assisted, and certainly now memory care.
Well, you feel you do a great job in filling that niche market that you're in, and I hope you have a great 2013.
Thank you, Steve.
All right, good catching up with you.
Thanks.